Hi there. It's hard to believe we're at the end of another financial year, so it's time to put in place the strategies that could save you paying more tax than you need to. One of the key options to consider involves your superannuation contributions. So why contribute to super? Investing funds in superannuation is the most tax-effective way to hold your funds for retirement, as tax on profits is capped at 15% while you are working. This is generally much lower than the tax you would pay personally. Once funds are in a retirement pension, you won't pay any tax on earnings as long as your pension balance is under $1.6 million. Additionally, once you turn 60 and retire, you can withdraw income and capital completely tax-free. You also get the benefit of getting a tax deduction for concessional contributions when you put money into super. So if you contribute your own funds to superannuation, you can claim a tax deduction for the amount contributed up to the $25,000 concessional contribution cap. Just remember, this cap also includes employer contributions, salary sacrifice contributions, and any insurance premiums claimed as a concessional contribution. Catch-up contributions. Another great initiative to add to super is the ability to use any unused space in your concessional contribution cap from the previous financial years in this current financial year. For example, if you didn't add any concessional contributions to super in financial year 2019 or 2020, you can add an extra $50,000 to super this financial year alongside your normal $25,000 concessional contribution. To be eligible, the balance of your super needed to be under $500,000 at June 30, 2020. You may also benefit from the government co-contribution. If you earn less than $39,837, you may be eligible for the maximum super co-contribution of $500 from the government for an after-tax contribution by you of $1,000. The co-contribution phases out once you earn $54,837 or more. There's also the spouse contribution. If you have a spouse with income below $37,000, you may be able to make an after-tax contribution of up to $3,000 to their account and receive a tax offset of up to $540. The tax offset is then progressively reduced until the offset reaches zero for spouses who earn $40,000 or more. Some conditions do apply if your spouse is over 66. Non-concessional contributions. If you wish to add funds to superannuation from after-tax funds, the annual non-concessional contribution cap is $100,000. If you're under 65 and have not exceeded its cap in the last 3 years, you'll be able to bring forward up to 3 years of this limit, which is $300,000. If you're over 66 and still working, you may still be able to contribute $100,000 per year. If we manage your superannuation account directly and you would like information about your total contribution amounts for financial year 2021, or how to make your contributions by EFT, BPay or direct debit, please contact us. This year, all electronic contributions should be made no later than Friday the 26th of June to make sure the funds clear in your account prior to June 30. Please note that from July 1st, the concessional, the non-concessional and the balance transfer caps will increase to $27,500, $110,000 and $1.7 million respectively. Other tax savings ideas to consider before the end of June include capital gains and losses. You may have sold investments that were no longer appropriate for your circumstances, and any capital losses realized as a result can be offset against any capital gains that you've realized throughout the year. Unused losses can also be carried forward to offset capital gains in future years. As always, advice should be sought before making changes to your investments. Prepaying interest. If you have an investment loan, you can arrange to prepay the interest on that loan for up to 12 months and claim a tax deduction in the same year the interest was prepaid. Instant asset write-off and full expensing for business owners. The government has announced the extension of the instant asset write-off until 30th of June 2023 as part of the temporary full expensing initiative. Your business can claim a full deduction for purchases of new eligible depreciating assets and also eligible second-hand assets if your business has an aggregated turnover of under $60 million. Negative gearing. Negative gearing refers to the cost of borrowing and other income generating expenses exceeding the income generated by that investment. This excess cost can reduce the tax you pay on other income. It's important to keep receipts for all costs accrued from your investment, such as investment repairs, real estate costs, and tax or investment advice fees relating to this investment. Income protection insurance. If you hold an income protection policy in your name, then any premium payments you make are tax deductible. If you would like to take advantage of some of these strategies, please contact our office for assistance. As always, thanks for your time and speak to you again soon.